There's a mistake I see happening with the Roth IRA that happens over and over again, and it's not choosing the wrong investments inside of the Roth IRA. It's actually not understanding how the plan works. And I'm not talking about the Roth IRA's tax-free growth, which is great, but not the topic of this video. So I'm going to show you how this works and probably show you something about the Roth IRA that you weren't aware of and probably have never seen before. So I'm going to show you using the Roth IRA of somebody that's saving $16.44 per day and give you an income in retirement of $173,000. And I'm also going to show you how you can retire early and something that you need to be aware of. So I'm going to go ahead and pull it up on the screen and we're going to go through this together. So I put together this Roth IRA savings plan that's going to equal $6,000 on an annual basis. Now, if you're 50 or older, you can do an additional $1,000, bringing the total to $7,000. But for this walkthrough, it's just going to be $6,000 up until retirement. So this plan is going to start at age 28, saving $6,000. And when we're 65, we're going to have saved $222,000. That's just the contributions. Now, if we take that money and we invest it into, say, the S&P 500 at a 10% annualized rate of return, before retirement, and then during retirement, we're going to make it a little bit more conservative at 8%. Now, I do get asked this question all the time. Every time I do these illustrations, how did I get 10%? How did I get 8%? Where am I getting those numbers from? They are somewhat arbitrary, but I'm using historical data. So if we take a look at the S&P 500, and this is a chart of the S&P 500 that I use all the time in my videos, from 1926 till 2021, the S&P 500 did an annualized compound rate of return of 10.5%. So there you go. That is how I get the math. So let's go ahead and pull this up back on the screen. And we're just going to use 10%. And again, like I said, we're going to dial it down in retirement to 8%. So going from 0% rate of return, just making those contributions, equaling $222,000, that is going to bring our total contribution plus the growth to $1,980,258 for basically what we would say is day one of retirement. Now, if we start that in retirement, we retire when we're 65 and live until the age of 95, that means we're going to be able to spend $173,000 each and every single year up until we're age 95. And you can see here from this illustration that we have $181,958 left. Now that seems like a lot, but anytime we have a little bit of error, meaning let's say we didn't get exactly 10%, it was 9.8%, that is why we want to have money left over. We don't want to run out of money at the end of the plan. So for these illustrations, that's why I'm using these numbers. So now let's flip over to retiring early. So instead of age 65, let's bring that down to age 55. And let me show you how much we're going to have day one of retirement. That'll be the year 2048. And that is going to drop from our original number of $222,000 to $162,000. So I just want to show you these numbers. So if we add in our 10%, there's something interesting that's going to happen. If we add in our 10%, that is going to drop from our original $1,980,000 down to our new $726,000. That's a huge drop. Not just for savings, but also for our rate of return. So our total portfolio has dropped significantly. That means we're only going to be able to spend $59,500 or thereabout each and every single year. Also a massive drop. But there's a couple of points that I want to talk about before we move forward on this video. And that is, first, you saw the massive drop by just retiring 10 years earlier because we were able to save significantly less or weren't able to save as much. And we didn't have enough time for that room to grow, which is the huge benefit of the Roth IRA. But also the fact that we have to take the money out before age 59 and a half, retiring at 55. There is a way. And that way is using the rule of 72T, or also known as substantially equal periodic payments. And that simply means we could take out the money before age 59 and a half and avoid the 10% penalty. But we cannot avoid the ordinary income. So any of our contributions, any of the money that we put into the Roth IRA, you could take out tax and penalty free for any reason. It doesn't matter. You can take it out next week, tomorrow, next month, whatever. It doesn't matter. But the growth portion, which is what we inevitably need to take out, a portion of it before age 59 and a half will still be subject to ordinary income. So if you're doing any of this math on, say, a financial calculator or another calculator that's not taking into consideration the tax consequences, you're going to be wrong. And the point, if you're wrong on this stuff, then you're not going to have any money later in retirement. And that could be age 94 or 95, but that would make the plan completely fail, not having taken that into consideration. And we're not talking a lot of money. There's only 2 years in this illustration that was showing us an $8,000 and a $2,000 tax liability. And in the grand scheme of things, that's not a whole lot of money, but that could be the difference of an entire year. And in this case, that's $59,500 or over $100,000 difference if you didn't take into consideration the tax consequences of different strategies. So we don't see that if we're retiring at age 65 because all the money that comes out of the Roth IRA is tax and penalty free because that's how the Roth IRA works. But if you take it out before age 59 and a half, you have to remember that there is a way to avoid the 10% penalty, but not a way to avoid the ordinary income on any of that growth. Now, here is the detailed cash flow report to show you those taxes at age 57 and 58. So 57, we have a projected $1,833 in taxes, and then at age 58, $8,812 in taxes. Now, the reason that didn't start until age 57, it didn't start at age 55, is because we can take out our principal, our contributions of what we put into the Roth IRA, tax and penalty free. But we went through that during our ages of 55, 56, and part of 57, and then we started taking out our growth portion to the Roth IRA early, before age 59 and a half. That means we can avoid the 10% because of the substantially equal periodic payments, but we can't avoid the ordinary income taxes. So that is a consequence, so to speak, of retiring early. And obviously, you're going to have significantly less in retirement on an annualized basis and less time saving for retirement by retiring early. So the first one is the $1,644 per day can give you a nice healthy retirement of $173,000 on an annualized basis. But if you do retire early, you just need to be aware of the unintended consequences of additional taxes by pulling that money out early. So I hope this has helped with the Roth IRA and your overall plan. If you have any questions, let me know in the comments down below, and we'll see you on the next one.